Hey there, thanks for stopping by. My name's Dave. I am the Wall Street Cowboy. I'm going to talk today about the SaVE 2. For those of you that have watched my channel before, you know I have a SaVE trade, and it's one of my very, very favorite trades. I make a lot of money from them, and they work very well. They do have some nuances that make them pretty complicated. So I'm going to go through this new version. There's nothing wrong with the original one. This is just a new twist on the trade. I call it the SaVE 2. It's double the size. So we're going to go get started on that. Before we do, I want to go through a few disclosures here real quick. First of all, we are not financial advisors. We're not a broker dealer. We do use securities as examples for illustrative purposes only. What we generally look at is a paper trade, or we look at a live account, but during after market hours. So you shouldn't think that you could duplicate what I'm going to show you here exactly, because there could be changes due to slippage and price fluctuation and other variables. You should become very aware of how options work. We're going to talk about options. If you have a broker, you can request a guide called The Characteristics and Risks of Standardized Options. You should be able to get that for free and familiarize yourself with the risks that are associated with trading options. I don't have anyone that has done a third party evaluation of any testimonials or claims. So do your own due diligence, and we'll go ahead and get started. So this is what the risk profile, or a graphic illustration of what the SaVE trade looks like. Giving just a brief overview, if you're unfamiliar with what a risk profile is, this magenta, or what may appear to be a pinkish line, represents the profit or loss based on today plus 0 days. So we call that the T plus 0, today plus 0, or T plus 0 line. The more bluish line is where the P&L, the profit or loss, would be if price was at that point at expiration. So this dotted line here represents an approximation of what the price was on that day at the moment that I took this picture. So it is crossing the magenta line, and here is the 0 P&L. Above is a positive profit, and below would be a loss. So it was right around break even. And at expiration, if price was at that same point, it would be above the 0 line or at a profit. If price was down here, for example, at expiration, it would be at a loss. And also, if price was here today, we would be working at a loss. So that's how that works. And it's just a graphic representation, an illustration of the approximate value of this trade at any one time. We can slide these dotted lines up, or forward in time or backwards in time. And this is a representation of price as it goes through time. And this is a representation of profit or loss. All right. So that is what the SaVE trade looks like. I do suggest, if you have not yet become familiar with the SaVE trade, you go listen to the previous SaVE trade presentation on YouTube. I do talk very slow in that. There are a lot of working parts to this trade, and I purposely talk slow so it's easier to grasp. If I'm talking too fast in this one, please go back and rewatch or watch for the first time the regular SaVE trade presentation, so you become more familiar with how this trade works and the risks and rewards. All right. So The SaVE trade guidelines, this is the original SaVE trade. Um, it does require portfolio margin or span margin. Span is what you use if you're trading futures options. And it's also something that could benefit you if you're trying to do this in an IRA. For the most part, IRAs cannot have portfolio margin. You would check with your broker to see if they do offer it, but in most cases, they do not. So SPAN may be an alternative for you. And there are plenty of presentations out there that explain what SPAN is. The trade usually lasts for approximately 45 days. It can be a little bit longer, a little bit shorter, but that's roughly the middle. The max loss on the regular SaVE trade is $10,000 per tranche. A tranche is one complete set, and we'll talk about what that is in just a moment. The margin requirements per tranche is $25,000. There's an asterisk after that. We are never going to actually need $25,000 of margin. I always like to have extra so that I can do modifications and adjustments along the way. I have never needed to use $25,000 of my margin. But if I have a portfolio margin account, you should have roughly $100,000 to $125,000 of margin or more. And I would use up 25,000 of that for this trade, which means it would be set aside from what I have available just for this trade. In the SaVE trade, you're going to go out 120 days till expiration, and we're going to use the SPX. You can use the Russell, but we're going to stick with the SPX. It is a much more stable security to use. The Russell tends to be a little bit more volatile. So we're going to sell 10 of those, and we're going to try and get about $10 for each one of those. $10 of the SPX equates to $1,000 of credit. So that's the ratio. So when we say $10, we know that that means $1,000 in actual dollars, and 10 of those means that we would bring in $10,000 of credit. We would use that credit to buy 13 90 days till expiration, so less than the sell side of either the SPX or the Russell. And we would try and find the strike that's trading at about $5. So we would bring in $10 times 10. We would send out 13 times $500. So there would be a net credit between the two. We're going to talk about the 120 and 90 days in just a moment. We would enter the trade the week after monthly expiration. That's not a hard rule. You can enter it any day that you like, but that's the best day that I have found. All right. So to review the SaVE trade, just as it is, first of all, this trade requires portfolio margin. Portfolio margin allows you to have much greater margin usage. And if you're unfamiliar with portfolio margin, I recommend that you talk to your broker and have them fully explain it to you. It is required because we are going to go to the 120-day till expiration options, and we're going to sell those. We're going to sell 10 of those at approximately $10 each and bring in $10,000. We are also going to go out to the 90-day options, days till expiration, and we're going to buy 13. Now, because the ones we own or buy will expire in 90 days, or we'll get out of them, we'll close them manually in 90 days or less, it is physically possible to have those short or sold options, which is your risk in the trade. That is why portfolio margin is required. You could be what they call naked puts, and your broker may or may not allow you to do that unless you have portfolio margin. So that's the reason for portfolio margin, because the protected side, the long side, would expire in 90 days. The short or risk side would be 120 days. Therefore, being naked, the puts, your broker may require portfolio margin. Again, we're going to enter the week after the monthly expiration. That's the third Friday of the month. Again, that's not a hard and fast rule. The initial margin, once we put on the trade, is going to use about $8,000 of the $25,000 we're going to set aside. So we're going to assume the margin will inflate from 8,000 to maybe 16,000. I have seen that happen on a number of occasions, but I have allocated $25,000 just in case I need extra buying power to help this trade along. I've never had to do that, but I keep it aside just in case. And then there are a number of exit scenarios. We have what's called A, B, or C. We're not going to go through C today. And we're just going to briefly go over what the SaVE trade is. We'll be getting into the SaVE 2 primarily today. All right, so let's do the math real quick on that. We're going to sell 10 of the $10 options, whatever strike that happens to be at 120 days out. That's going to bring in $10,000 in credits. We're going to buy 13 puts with those dollars. So we're going to spend $6,500. That's 5 times 15, or $500 times, not 15, 13. $500 times 13, which is $6,500. So we're going to bring in a credit of 10,000. We're going to have a debit against that credit of $6,500, and that will result in a net credit of $3,500. Now, if we were to hold this all the way to expiration, we could realize $3,500 in credit on a successful trade. We would never, in any situation, hold on to these until the expiration of either of these. We'll be out of this trade before the 90-day long puts would expire. So we'll never actually see the entire 3,500, but that's what would come in, and that's what is the net credit after the debits. All right, so exit scenario number A. This is the real basic exit. We're going to sell 10. We're going to buy 13. We're going to end up with an initial credit of 3,500. Then we're going to place a good till cancel order to exit the trade entirely at 50% of the credit received. So we're going to put an order out there that will cost us $1,750 to close the entire trade, and we'll keep what's left over of the 3,500. That's going to be about $1,750. It should occur at about 45 days, maybe as long as 60 days, depending on how the market is behaving between the time we enter the trade and the time we're able to exit the trade. So this is the real simple exit strategy. You enter the trade, you look at what half of the initial credit is, you put the good till cancel order to close the trade at half of the credit received, you keep the other half. Now there's an asterisk there next to the green $1,750. That means that that's going to be slightly higher or lower based on slippage, based on commissions, but that's approximately what you could expect to earned from a successful SaVE trade. All right, so now let's look at exit scenario B. This is, we're going to be doing the exact same thing. We're going to sell 10 of the $10 puts at 120 days out. We're going to buy 13 of the $5 puts at 90 days out. We're going to have a credit of $3,500. We know all about that. We're going to put a good till order, an order to close, good till cancel order at $1.50. Now let's do the math here. We're going to bring in $10 per put. We're going to spend $5 per put. That is called a spread. It's a diagonal spread. That is a net $5. $10 minus $5 is $5. So when we open this trade, that's the credit we're going to receive for each one of the complete spreads. We're going to put a good till cancel order to close that at $1.50 for each of those spreads. All right, so bring in $5. We're going to spend $1.50. So that'll cost us $1,500. So 10 of the shorts and 10 of the 13 longs. So we're going to end up with $2,000. But remember, we have 13 longs. That means we're going to have 3 extra long puts that are completely paid for. Now, it's really nice to have long puts in the event of a crash or correction, because puts is what everybody wants when that happens. So this scenario results in a credit of $2,000 and fully paid for long puts when you get done with the trade. Okay. And then the let's say that we do an adjustment. We'll talk a little bit about adjustments. We're going to do the same thing. We're going to have $3,500 of credit. We're going to buy 1 or 2 additional puts. Let's say that they cost us approximately $2.50 each. So that would cost us $500 for, or even if they were $5 each, $500 for one. That means that we would have a good till cancel order to get out at $1,500, 10 of the 10 shorts, 10 of the 13 longs, plus 4 or 5 extra long puts. So we're gonna have a little less money, about $1,500 instead of $2,000, but now we're gonna have 4 or 5 long puts, and we only have that if we need to adjust the trade. So that's just kind of a brief summary on the SaVE trade. We're now going to get into the SaVE 2, which is the whole purpose of this trade. It's going to be very similar, except it's going to be double the size. So this trade also requires portfolio margin or span. We're going to be in about the same amount of time. The maximum loss on this is double what the original SaVE trade is, because it's going to be double the size. So the maximum that we would allow ourselves to be at risk of losing is $20,000. Now, you're going to see that $20,000 is highly unlikely we would ever reach that. I suppose it is possible, but we're going to be out of the trade way before we get to that point. So don't let that big number frighten you. When I do lose money on these trades, it is significant, but it's never been $20,000. Okay, so since we're doubling the size, instead of $25,000, I need $50,000 of margin set aside. So if I have $125,000 portfolio margin count, maybe the SaVE trade 2 is too big. If you had a $500,000 account, then perhaps this is a more appropriate size, even maybe a $200,000 or $250,000 account. All right, so we're going to basically double the size with one exception. So we're going to sell 20 instead of 10. Same 120 days till expiration, and we're going to get that same $10. So we're going to bring in $20,000 instead of $10,000. But we're going to double the number of puts we buy, and we're going to then take one away. So instead of being 26, 13 plus 13 being 26, we're only going to buy 25. 90 DTE, days till expirations, SPX, at about $5. Same. But we're going to save that $500 or one extra long put. Instead of doing 26, we're going to do 25. We're going to save $500 because that 26th one would cost us $500. So we're going to save that money. We're going to use it for something different. So just want you to be aware that that is a difference, and that is the biggest difference in this trade. All right, we're going to also enter the day after monthly expiration, or the third Friday of the month. Now, let's go through the exit scenario of the SaVE 2. Going to bring in $20,000. We're going to spend $12,500. That's 25 times $500, or $5 for each one of those. So we're going to bring in 20,000. We're going to spend 12,500. We're also going to use that $500 that we saved from not buying the 26th, and we're going to buy a slow melting hedge, a hedge against a slowly melting market. That's going to be a debit of about $500. Sometimes it's $450, sometimes it's $650, but it's going to roughly be $500 for this slow melt hedge. We'll go into that in a little bit, what that is. So we're going to bring in an initial credit of $7,000. So if we bring in 20, we spend 12,500 on the long puts, we spend $500 on a slow melt hedge. The end result is $7,000 of initial credit. We're going to place a good till cancel just like we did before at 50% of the initial credit. That's $3,500. We're going to exit everything that we can with $3,500. We're going to keep $3,500. But I want you to remember, we bought a slow melt hedge at $500. That is going to still have some value. And we're going to show that in a little bit. This again should take about 40 to 45 days, sometimes as many as 60 days. So that's exit scenario A. Bring in the money, put in a good till cancel to exit at half the credit received. We'll keep the other half, and we will also have a slow melt hedge that is again fully paid for in our account to protect other trades that you may have on that have potentially some risk against a correction. All right, so now let's look at exit scenario B. Very similar to what we did before. We're going to sell 20. We're going to buy 20. And that would bring in $10,000. And we're going to buy an additional 5. That's going to be 25 there. Hopefully the math makes sense to you. That would cost us about $2,500. So it's the same 20,000 and 12,500. I'm just breaking it up a little bit for a reason. Results in a net credit of $7,500, just like it did in scenario A. Less the $500 for a slow melt. So $7,000, just like in scenario A. I want you to think of it, though, as a diagonal with 5 extra long puts in this scenario. We're not going to try and just get out of the entire trade. We're going to want to keep some or all of those 5 extra long puts. Now, in this scenario, this would be if you were if you felt that there was a higher possibility of a correction at some point in the future. Once you're out of this trade, you would want to have that extra protection. If you don't think that threat is a high probability, then you would want to go with scenario A. This one gives you those extra long puts. So we're going to sell 20. We're going to have a net buy of 25, but we're going to hold on to those extra 5, or at least some of those extra 5. So we're going to place a good till cancel to sell to close at $2.50, and maybe sell 3 or 4 of the excess 5 long puts. Depends on how much protection you want. The cost, $5,000 of the $7,000 that was brought in to close those diagonals, the 20 plus 20 and negative 20. Now we're also going to bring in something for however many of those long puts we sell, 3 or 4 or 2 or whatever. And that's hard to determine. It could be any price at the time that we close this trade. So it may be $2 for each one of them. It may be 75 cents. It's hard to determine what the value of those excess long puts would be. But it's going to cost us $5,000 to get out of this trade. But that's going to be offset to a small degree. Let's assume $100 for each one of those, and I sell 3 of them. It'll be $5,000 less the $300 brought in for 3 of those excess long puts. Okay, so there are basically 5 different types of markets. All right, number 1, it goes up very, very fast. We're in a bull rush. And then the more typical, we kind of grind up slowly. Sometimes we go sideways and consolidate for a while. Occasionally, we have a very slow melting, choppy, maybe even in backwardation market. And then we have a fast crashing market. Of those, only the slow melting, choppy, maybe even in backwardation is the market that gives us trouble. And that does happen, but not nearly as often as the other scenarios happen. So it is one of the scenarios that we have to prepare for, but it is very, very rare in relationship to the other 4 potentials. All right, so let's go ahead and bring up Thinkorswim, and we're going to talk about how we put on one of these trades. Now, again, this is for illustrative purposes. The market's closed. These prices are today's prices. They wouldn't represent the exact same prices you might see when you're putting on this trade. All right. Down here are the simulated trades that I have created. We're going to use those, but I'm going to go ahead and create trades so that you can see how we do this. I'm using Thinkorswim. You may have a different platform. You'll have to modify this presentation to suit the platform that you're using, but it should all be pretty similar. So you shouldn't get lost at all. All right, so this is that same thing that we saw before, the risk profile. This gives us our P&L. Anything above the 0 line is a profit, anything below it is a loss. This represents the current price of the scenario or of the security, the different ranges it could be in. This would represent a potential price. This one in the middle happens to be the current price of the SPX, which happens to be today at 3677.95. And so we have that unlocked, and then we have the dollar. So that's telling us that it's today's current price. We have not added anything to that. I've given the scenario where we might be down 13%. That's this vertical line. If down 13% would be 3199.82, which is this number here. And the scenario might be that we rise 5% over time. And that happens to be this vertical line here. So it kind of gives you an idea. First thing we're going to do is we're going to build this trade. Keep in mind that we don't like these to be too wide on the spread. Let's talk about that. A spread is the difference between one price and the other, or one strike and the other. One usually we sell, the other we buy. So that's called a spread. The difference between that, in this case, you can see $100 versus $100.40. The spread is 40 cents. And the difference between here and here might be, what is that, $1 and $20.60? My math right there. So the difference, or the spread between, is the difference in price between what we would sell it at and what we buy it at, or if we're doing it in the opposite, if we're buying this and what we're selling at, that is the spread. All right, so I like to open these up to about 300. I like to get a whole lot of strikes because I want to get all the way down to where I can see $5 and $10 strikes. Also, as you may remember from the original presentation, you don't want these strikes between where we buy or sell and we take on the other side. We don't want those to be too much wider than 50 points. You can see this is 26.25, 26.50. That's 25 points difference. That would be fine. 26.50 and 2600 would be fine. 26.50 and 25.50 is not fine. It's too wide. So we would never want to be that wide. And that's going to be important. So we're going to go look for something that's right around $10. I think these are running right around $10, $24. Now, I want to go out 120 days. You can see that the closest I can get is the 122 or the 123. Whichever ones you want to use of these, whichever one you like. I like to use the AMs. These are the ones that stop trading on a Thursday and they settle on Friday mornings, the third Friday of the month. I like these because they generally have more volume than what these are called weeklies. These are the ones that stop trading on Friday and settle at the close of the market on Fridays. Actually, I think they actually settle on Saturday, but since the market's not open on Saturdays, it's, for all practical purposes, it's where we ended up when these stopped trading on Friday. All right, so we're going to open these up. We're going to go find, because these are the 120 days, so those are the ones we sell, right? We're going to go find what's trading at around $10. Now, these are up around $15. I don't want to come down here because we don't really have a lot of strikes in between. It looks like they're separated by 100 points. We don't want these to be 100 points wide from what we sell and what we're going to buy in a different month. So since they don't have a whole lot of variety here, I kind of want to stay up here where I can get some pretty good variety of strikes. So I did find, I already went through this. I did find that the 2400 was the right one. We're going to end up with the $5.90 credit. It's a little rich. We like to get closer to $5. In other words, $10 for the credit side, $5 for the debit side, at net $5. There just wasn't anything available today, but that's what we want to look for. So I went ahead and I'm going to sell. Just going to click on that, and it's going to populate that down here at the bottom. One of the February 17th of 2023. That's approximately 120 days in the future. And they're currently right around $15. Again, we want something that's closer to 10, but we'll have to work with what we got today. Now we're going to close this up. We're going to go find the 90 days. Same thing, AM, or you could do the weeklies. That is 1 day further. I like these because they tend to have more volume on them. I'm going to open that, and I'm going to go look for whatever's at around $5. Now, in this particular case, I don't want to use something that is too far away from 2400. I want it to be 2350, 2375. I wouldn't want it to be 2325. So I chose the 2350. So we're going to press down the control key so that we marry to this ribbon right here, whatever we click on. This is the ask side, or the buy side, long side, if you will. And I'm going to click on the 2350. And you can see it came up with the $5.90 credit. That's pretty close to where we want to be, right around $5. I'm going to go ahead and delete that because we already have that here. It's the same strikes, exact same thing. All right, now that is our initial transaction. Now we want to adjust the number. So the first thing I'm going to do is I'm going to drop down this arrow, and I'm going to click on 20. So now I'm short 20, or selling 20, and buying 20, long 20. I'm going to go over here where it says diagonal. Diagonal means we have two different expirations and two different prices. That's what a diagonal is. If these were the same strikes, in other words, 2400 and 2400, then that's called a calendar. Okay, so this is a diagonal. I'm going to hit that drop down and make it custom, because we're going to adjust this slightly. And we're going to change that from 20. Remember, we want to buy 25 of these. 2, 3, 4, 5. And that has it does the math, and it tells us it's a $13.75 credit. That's because there is a ratio difference here between selling 20 and buying 25. So it's not $5, it's $13.75. But when we hit confirm and send, or build the order, if that's how your platform works, it's going to tell us that we're actually selling 5 of the combination trades, that is buying 4 and selling 5. If you multiply 4 times 5, that's 20, and 5 times 5. So we're getting 5 of these and 5 of these, right? 5 of these and 5 of these. So that would make 20 and 25. So it's actually 5, and it has a minus sign in front of it because we're selling it or getting a credit. So we're selling 5 of the 4x5 combos. And you can see this says illegal. That's because this particular account is not a portfolio margin account. This one is just a normal account, no special privileges. So it's telling me right here, I can't do the trade. And why can I not do the trade? Because it already recognizes that This is further out in time than this, and I don't have the privileges of doing naked puts in this account. So if you see that, it's because your particular account isn't set up with portfolio margin. And if you qualify for that and you want that, go ahead and talk to your broker. They'll go ahead and tell you how to get that all set up. They should be able to do that within a few days. All right. So I'm going to bring in a total credit for the 5 of these of approximately that $7,000 that we were looking at. Now that takes in consideration any commissions and fees and things like that. So it's going to be roughly that $7,000 that we were talking about. All right. So that's how I build it. I don't need 2 of these, so I'm going to take one of these out. Looks like prices are moving a little bit in the after hours. All right, so that is the credit that I would receive. Now, now my trade is set up. Let's take a look at what that looks like. See if it resembles that picture that we saw at the beginning. I'm going to click that. I'm going to just grab this with my mouse and drag it this away. And I'm going to take this. I'm not going to drag it too far back. Let's take it back to here a little bit. All right. So to this side, you want to grab the number and bring it back. Over on this side, you want to grab the actual graph. All right. So remember, this is 13% down. That's 13% down. That generally is where the lowest point of this magenta or T+0 line is. And that's really important because this is what we're managing against. We're managing against what would happen if we had a 1-day 13% correction in the market. That would be the lowest point of this magenta line. That is the worst point on it. Any other place than this is better than this point right here, anywhere along this magenta line. Okay. So 13 generally is where that is, and that's why I use 13. 5% is generally how far we go up. So over a 40-day period, 40 to 45 days, that's pretty common, 5, maybe 6%. So that kind of gives us an idea of where we can make our money. So that's what this is. Now, remember, we talked about putting on a slow melt. This is the part that we haven't talked about in the past. All this other stuff is pretty familiar with any previous version of this trade you may be familiar with. So what's a slow melt? Well, it's a diagonal that we built down here. Shouldn't be a diagonal. It's a vertical. It's this vertical right here. All right, so let's take a look at something real quick. This expires in February and in January. We know we're never, ever, ever going to hold this trade to expiration of either side, neither the long side nor the short side. Neither one of those are ever going to reach expiration. We're going to close this trade before that happens. So what is the expiration that would be before January 20th? Well, it should be December, the last trading day of December. That would be the expiration right in front of this. I mean, there could be weeklies in front of that, but I'm talking about something that we could get into today. What expiration would be in front of January 20th? So let's open up simulated trades. Let's close this up. Let's take a look. And there is the December 30th. These are quarterlies. They come out in December. They come out in March. They come out in, I guess, June and September. These are quarterlies, but there's always something at the end of the month. It could be a quarterly. It could be a monthly. If we come up here, we should see something at the end of November. Here's November 30th. It's considered a weekly, but it doesn't matter whether it's on a Friday or Monday. This is the last trading day of the month, and that's the one we're looking for. We're looking for the one that is the last trading day of the month, just prior to the front month, which is January. That's before February, so it's considered the front month. This is considered the back month. We want the expiration for the monthly, or the end of month, I should say, probably a better term, the end of month for December, which is directly in front of January 20th. So in this case, that's December 30th. Now, the reason I do that is so that I never, ever step on this trade. This is the only thing I ever do in this expiration. It will always be the only trade I do. If by the time we get to December 30th, I should be out of this trade, or I will either cash this in or I won't need it anymore. But it's life expectancy. I don't need this any longer than December 30th, because in the worst case scenario, I'm only going to be in this trade maybe a few extra days. I'm certainly not going to be in it January 20th. So that's as much protection as I need. So I don't do it in November because I'll still be in the trades, perhaps into December 15th, December 12th, but I won't be in this trade after December 30th. And if I am, it won't be for much more. It'll be a day or two, but not much more. Anyway, so we're going to use the end of month. Open that up. Now, I don't need 300 strikes. We're going to change this to 100 just so that we don't have so much to go through. Now, I have this set up to show me deltas, and that's what I use. I'm going to look for whatever is around, it doesn't have to be exact, but around the 30 delta. I want to go to whatever is the $25 increment. See, this is a 95, that's a $5 increment. This is a 90, that's a $10 increment. This is $25. $25 less would be here. $25 less is here. And that's why I use it. Now, could I use the 27 delta? Sure, you could. Sure, you could. Could I use the 29 delta? Of course you can. It just wants to be on the 25 increment, or something that's divisible by 25. So I like these, and I could just as well use these up here. But I'm going to start with this. I'm going to buy the 34.75 because it is closest to the 30 delta. So I'm going to click on that, and then I'm going to go 25 points, and I'm going to find whatever strike is 25 points further out of the money. I'm going to hold my control key down. That'll marry this to whatever I click on, and we're going to click on that. So you can see that's costing me $6.30, $6.35. Generally speaking, it's about $5. I have seen them at $4.50. I have seen them at $6.50. They're right in there. It's about the $500 that we saved by not buying the 26th long put. There is where that's going. Now, because this is a hedge, these strikes aren't that critical. I could just as well say I'm going to buy the 34.50 at a 27 delta and go to 25 strikes. Let's do 100, I don't know, 10. That'll give us plenty. The 34.25, right? Yeah, 34.50, 34.25. I'm going to marry that. And see, that's much closer to that $5 fee cost. It isn't going to make that much difference. So if that uh, it makes your life simpler, not paying the extra $130 because it's $6.30 today, and this makes it closer to the $5. If that makes your life easier, then knock yourself out. Either one is fine. It very rarely will you even need this, but it's there as a safety valve. That's it. It's not going to save the trade. It's going to assist, but it's not going to be enough to fix all the problems in the trade. But it gives you something to help combat against a slowly melting market. So let's take a look at what we got here. I have this one and this vertical. I locked it in at $5. Let's unlock it. 635. Okay. I'm just gonna lock it just so that we don't get a lot of movement. So I'm going to uncheck this because we have the risk profile for that right now. I'm gonna uncheck that. And this is what our slow melt looks like. It's very little cost for a whole lot of protection. I could protect my trade up to $2,000. Now, the market doesn't have to go very far before it gets into here. And the closer we get to expiration, the closer we get there. So if we go out here to say December, and we're fully expecting to be in this trade as long as December 30th, maybe a few extra days. That's kind of where we're expecting to get out of this trade. To get out of here to maybe December 19th. If price is down here, we're going to benefit the more this slowly melts into this. If the market only comes down this far, that's not going to hurt our trade. The SaVE trade will absorb that. This isn't going to hurt it because it's a theta trade. Theta will eventually bleed out. Vega will drop off and the trade will be profitable. If we get beyond here, then we start getting into what we call that trough here. And we get down into here. Well, this is way beyond 13% down, way. So we're going to be in much better shape anywhere in here with the SaVE trade. It's going to be able to handle that just fine. If we get beyond here, then we start needing help from something like the slow melt. That's where this comes in. So that's why I have it. It doesn't cost us anything more than double the size of a typical SaVE trade. We're just reallocating $500 to give us something to protect us in the event we need it. Now, in most cases, we're not going to need this. In most cases, the market is going to go higher, and this will continue to bleed off, and we'll lose more and more and more money. But you can see even at December 20th, this still has some value, and we could sell it for something. Usually I get about half. If I spent 500 on this, I usually get 250 for it when I get out of it, or 200. I get a pretty good portion of it. So I'm not going to ever see a max loss on this. Now I could keep it. I could keep it as a hedge for other trades. Maybe I have a bull put that I put on down here, or some naked puts, or some kind of broken wing butterfly or bearish butterfly. I could use this, multi-purpose it out once I don't have a SaVE trade on. You can keep it. It doesn't cost you that much, and you're going to bring in way more than this $500 from your trade So this is fully paid for by the time we're done. This is a really nice hedge to have on for a multitude of trades. So you don't have to get out of it, but I generally do, because I generally build another one for my next safe trade that's at a different strike. So I don't need to have too many of these on. All right. So at any rate, that's the major difference between the two trades. Now, let's talk about adjustments. This, when you only cash this in if you're going to cash in this. If you're going to just close the trade, take the loss, then you cash this in. Otherwise, it's just there for protection. This $500 doesn't mean anything anymore. It's money you didn't spend. It's already accounted for in the credit you received. So this is a fully paid for hedge. You don't have to get out of this unless you're going to trade that. You're going to close this. If you're going to close this, then close this. Now, what is our adjustment point? Let's take a look at this. Let's take that off. Remember that the way that we do this trade, if here's today, here's the magenta line, we can see about 13% down is the worst point. If we were 13% down, the trade would be down $3,500. What was our max loss? Wasn't it $20,000 for this? It was $10,000 on the regular SaVE trade. It's $20,000 on this. So if this line is ever sagging down to where that number is 20,000 or greater, then we have to do an adjustment. Now, hopefully we don't wait until it gets all that way. Once it gets down close, we start to make adjustments. But we don't have to make an adjustment at $3,800. Even if the market was to drop, let's say that it dropped. And if you don't know how to turn this on, just hit this little gear. That's what opens these. You get that, it'll open these. Let's adjust the stock prices right now at 3677.95. Let's change that. Let's say that we had a 100-point drop in the market. So we went down to, I don't know, 35.50. Close enough. That's a really bad day. Now we're down at 35.50. You can see at 13% down, it's still about the worst place we could be. It's only down $4,000, or the max loss is only $4,000. That's not anywhere near $20,000. We don't have to do an adjustment. What if that had happened maybe in, I don't know, we're right here on the 17th. Let's say it took us 2 weeks to drop 100 points. Oh, that dropped a little bit more. Now it's at 10,000. We still don't have to do an adjustment, but it is a point at which we might want to start looking at ways to raise this up, if at all possible. There are a number of ways to do that. There are a number of ways, and we'll go through a couple of scenarios that I use. And if you look at the last video on the regular SaVE, we talk about some. But where do we get ourselves in real trouble? Well, I've already gone through this. I think it's the 18th of November. So right about here. Now we're at 16. And if the market has continued to drop until we get down to about 3,300. So we're currently at what, 36? That would be a 300 point drop over about a month and a half. That's a really slow melting market, right? So now we're at 3,300. We're not down $20,000. We're only down $9,000, which is bad. But you can see we now have the potential at the worst point on this magenta line of being down $22,000. At that point, we have to make a decision. Are we going to fix the trade, or are we just going to take the loss? So hopefully we've done our adjustments along the way, but this becomes the point of no return. Once we get to here and it's $20,000, then we have to make some decisions. Now remember, we're at 3,300. Where are we on our vertical, our slow melt vertical, right? This one here. We're up almost $1,700. Oh no, I take that back. We're up about $1,000 at 3,300. So we would get back some of that. It won't, like I said, it's not going to cover the whole thing. It will cover some of it. And we've way more than paid the $500 there. So we would just close this and the trade, and we would book the loss. This is not going to fix the trade. It is only going to mitigate some of the loss. It's not designed to be a no risk trade. All trades have risk, but this scenario, market scenario, doesn't happen very often. All right. And there are other things that you can do in the meantime to help to mitigate that loss. So what are some things that we could do? Let's go ahead and we're going to take that off. We're going to put this back on, and we're going to change this to say November 1st. Okay, down 13% would be about the worst place we could be. We'd be down $11,000. What are some of the things we could do? Well, we sold these puts for $10. In many, many, many cases, by the time we get out to this point in time, we've already seen some bleed off on the value of these. In some cases, they've gone up in value, and that can happen. But in many cases, I'm able to see these, and let's say that for, I don't know, a couple weeks, we're going up a little bit. And these short strikes go from $10 down to $6. I will take that opportunity to help my trade just in case we have a sell-off. So one of the things that I will do is I'll buy back one of these 20. So let's go out there and simulate that. We're going out to the February 122 day. We're going to go to the 2400. I guess I need more strikes. And I'm going to buy one. Nope. Yeah, I sold it. Let's go ahead and change that to buy. And let's say that this has dropped down to, I don't know, $6. What will happen to our T+0 line when we do that? Let's come out here. Let's go out to, well, I guess that's a good date. Yeah, we can go out to the 7th. All right. So this starts to sag a little bit. We're starting to see that get to 14,000. I could buy back one of these. Watch what happens to this magenta T+0 line. It should go up, and it did. Where's our P&L now? Our worst case scenario is only $8,000. way below the $20,000 tolerance that we have out there. So there are a number of things. Whenever I can, I will take one. I'm not going to take off 4 or 5 of these. Um, I'm not going to take off 4 or 5 of these, but I can. I have been known to take off one. And a lot of times, what I'll do is I'll just build this order. I'll create a duplicate order, and I'll just make it good till cancel. And if it gets out there, it sees that price, it hits that price, it fills it, and I don't even know it happened. I just find out when I get ready to close the trade, I no longer have 20 of these because I bought one back. I only have 19. Yes, I am forfeiting a little bit of the potential profit in this trade, but I am also keeping my magenta line in check during my trade. So we can do that. We could buy back one of these diagonals. I think that's what I was simulating here. I could buy back one of them. And that will raise my T+0 line. So if I uncheck that, this drops. If my trade starts getting in trouble, I might buy back one of these and one of these. So I would have 19 and 24. Okay. It'll raise my T+0 line. Keeps my my overall risk in the trade at worst point, possible, and allows the market to go through its volatility and then finally catch a bid and start moving back up. I can always put that one back on later, but in the meantime, I'm reducing my risk. I keep my magenta line flat. I don't overdo it, but I have been known to do either one of these things. Buy back one of my risk, my shorts, or get out of one of the diagonals and keep that magenta line up. So that is the trade. These generally can make a couple thousand. I've made as much as $3,500 in these trades in an ideal market that just runs away to the upside and everything is clicking along the way we like it to. I rarely take any kind of a loss because I manage these, but it's a very easy trade. So what are the benefits? It's an income trade. It does give you a really nice Black Swan Hedge protection that will protect you in the event of a market crash, not a correction, but a crash. It can do very well up to a 13% pullback in the life of this trade. This definitely has positive theta most of the way in the trade, so you can live through this trade through many different market scenarios. You can end up with an extra slow melt hedge. You could end up with extra puts and that are fully paid for, so you can get income, you can get hedges for other trades. There's so many things that this trade opens the doors to, and you get all of them. So that is the SaVE 2. The big difference is the slow melt, and that we add that and we double the size, reducing the long puts by one to pay for the slow melt, and that is the biggest difference between the two trades. So hopefully that it was beneficial, and you'll have a chance to do this trade on your own. Paper trade at first. Don't ever do a trade like this until you fully understand what can and does happen and live through looking at this number. $-8,000 is scary. We don't want to see that. It does and can happen. Again, the good news is up days, this market, this trade just makes money. And bad days are really bad. So you don't want to see this go down from 3,600 to 3,300. You like it to be higher. You like to see this making money and getting up and making $900, making $1,500, making $2,000. The market has a positive drift. That's 60%, 65% of the time. That's what you see. Very rarely do you have a market that is consolidating to slowly melting. This trade can handle a certain degree of a slow melt, but this area down in here is where we get in trouble, right around 10 to 13% down. That's where we start getting in trouble. All right. Thanks for listening in. Give me a thumbs up, subscribe if you like. I'll be putting more videos up as we go forward. Thanks a bunch. Have fun.